Welcome to The Property Code. I'm your host, Nick. Today we explore how to invest in real estate in 2025 by following Maya's journey from uncertainty to confidence. Maya, a 31-year-old graphic designer living in Austin, had watched property prices climb steadily over the past decade. With remote work firmly established and tech companies expanding secondary hubs, she wondered how to begin investing without over-leverage or overwhelming complexity. One crisp morning in late spring, Maya sat on her balcony with a latte. She scrolled through an AI-powered housing analytics app that combined local demographic shifts, rental demand forecasts, and sustainability scores. In 2025, tools like these had become indispensable. They drew on machine learning algorithms to predict where young professionals would seek walkable, eco-friendly neighborhoods. Maya spotted a mid-rise building in a repurposed warehouse district near new co-working spaces. Vacancy rates there were below 4%, and rental rates had increased by roughly 6% annually for the past 3 years. Yet the property's purchase price remained within reach thanks to a recent rezoning that encouraged mixed-use development. Her first step was to define goals and risk tolerance. Rather than buying a large multi-unit complex immediately, she aimed to acquire a single condominium with value-add potential and smart home features. She saved $20,000 for a down payment, leaving a comfortable emergency fund equivalent to 6 months of expenses. She met with a mortgage broker specializing in investment loans, securing pre-approval at just under 5% interest for a 30-year fixed-rate loan. Although rates were higher than in previous years, long-term fixed financing remained attractive in a moderately inflating economy. Next, Maya refined her target criteria. She prioritized energy efficiency, given rising utility costs and tenant preferences for sustainable living. She focused on buildings with solar panels, green roofs, or high-efficiency HVAC systems. Co-living arrangements also caught her eye. Some investors in the area had transformed larger condos into shared suites with private bedrooms and common kitchens, achieving premium rents per square foot. In 2025, hybrid work drove demand for flexible living situations, especially among millennials seeking community without sacrificing privacy. After filtering options, Maya found a 2-bedroom unit built in 1998 that had been recently renovated with double-pane windows, LED lighting, and a smart thermostat. The seller offered it at a price 5% below comparable properties because the previous owner had relocated overseas. Maya conducted a thorough inspection, uncovering only minor cosmetic repairs. She used a chatbot assistant to estimate repair costs and timeline. The chatbot recommended vetted local contractors and projected that repainting and minor floor refinishing would cost around $2,000 and be completed within 10 days. With those numbers in hand, Maya ran a detailed cash flow analysis. She projected monthly rent of $2,200 against mortgage, insurance, property taxes, and management fees. After accounting for a vacancy reserve of $150 per month and expected maintenance costs of $75 monthly, her net operating income stood at roughly $1,200 each month. That translated to a cash-on-cash return near 6%. She also factored in appreciation. Historical data from the AI tool suggested the neighborhood would appreciate around 5 to 6% annually over the next 5 years, due to continued tech expansions and limited new construction. Confident in her projections, Maya drafted an offer letter detailing her earnest money deposit, financing contingency, and inspection timeline. She highlighted her strong credit score and pre-approval to strengthen her negotiation position. The seller countered with a request to close within 30 days. Maya arranged her cash flow so she could expedite inspections and appraisal. Within 2 weeks, all contingencies cleared, and they closed at a price $2,000 below her original offer, thanks to effective negotiation and the seller's eagerness to relocate quickly. Once the deal closed, Maya transferred $2,000 to the contractor. In under 2 weeks, the unit boasted fresh paint in neutral tones, polished floors, and a fully calibrated smart thermostat. She staged the condo virtually, uploading floor plan scans to an online marketing platform that used augmented reality to let potential tenants visualize furniture layouts. The first tenant signed a 12-month lease at 2025 rental rates, securing Maya a monthly cash flow of $1,200 after all expenses. Maya's learning didn't stop there. She tracked neighborhood performance using a dashboard that aggregated rental data, demographic changes, and planned infrastructure projects. In 2025, new high-speed rail lines, remote work visas, and green building certifications influenced property values, so she stayed informed through webinars, podcasts, and local meetups of young real estate investors. When interest rates dipped slightly in early fall, she refinanced to a 4.8% rate, reducing her monthly mortgage payment by $50. That move increased her cash-on-cash return to over 6%. By year's end, Maya assessed her portfolio, one well-performing condo, and a clear plan for expansion. She considered direct deals on duplexes or small multifamily properties, and she also evaluated syndications that allowed fractional ownership in new mixed-use developments near major transit nodes. Leveraging the network she built, she partnered with a friend knowledgeable in property management and another who specialized in sustainable design. Together, they identified a small 3-unit building near a revitalized arts district, where projected rent growth exceeded 8% annually. Maya's story illustrates the core steps to invest in real estate in 2025. Set clear goals, define risk tolerance, leverage AI-driven analytics to select neighborhoods with growth potential, align investments with sustainability trends, perform rigorous cash flow and appreciation analysis, negotiate effectively, and stay agile by monitoring market shifts. By blending traditional fundamentals, such as sound underwriting and due diligence, with 2025 innovations like smart home technology, augmented reality marketing, and data-driven forecasting, investors can build resilient portfolios that generate passive income, hedge against inflation, and create long-term wealth. Thank you for listening to The Property Code. If you found this episode valuable, please subscribe and leave a review. Until next time, stay strategic and keep building your financial future.